Welcome back to Margin. I sold everything and I want to explain why. So I thought we would have a little less structured discussion today around the topic of building a good defense for your personal finances. Now, this is something I focus on a lot. I'm naturally more defense-minded versus offense. But defense is basically protecting yourself against loss, whether by means of building reserves, paying off debt, redistributing assets, or even by having proper insurance buffers in place. So people often see those who are misers, maybe frugal or defense-minded as being pensive, maybe overly cautious, overly pessimistic, or probably having a little bit of a boring life. Now, I believe that there is always a healthy balance between taking ground by means of being offense-minded and ensuring that you are protecting yourself, protecting what you built by being defense-minded. Now, neither approach should be dismissed, no matter what the market conditions tell you. Now, having a good defense is more than just building a budget or a plan to spend, having adequate reserves, and ensuring you are properly insured. It's also knowing your own risk tolerance, what you are comfortable with in regards to your investments, as well as being a realist in the sense of knowing where we are generally in the economic cycle. Now, I believe that there's a lot of pandering to fear these days. Now, whether that be from a media standpoint, whether it be from how connected we are as a society to aspects of even political and social unrest and other components, we are just dealing with a lot of underlying fear in how we operate our day-to-day lives. Now, this factors in directly into your money as well and how you treat your money. So it's really important that you know why you do what you do to ensure that your positioning with a matter is not dependent on someone else's opinion. It's never a good thing to follow someone else's faith or beliefs, financial decisions, relationship advice, or even matters of health just because it's coming from someone you trust. Now, you need to have your own position based on why you believe and do what you do. Now, like I said, we are far too concerned about what everyone else is doing, what's going on in the world, and who's making what decisions, rather than what decisions are being made in our own households. So it's important for you to look at your own finances. What decisions are you making in your personal finances and why? And know what that why is. So I've seen this play out in so many different content producers who have basically taken a position of buying in or selling out of a market or an asset class just from a standpoint of their own convictions, their own reasoning, and so on and so forth. But what ends up happening is you have people following that advice and taking those leaps, whether good, bad, or indifferent, according to that content producer. Now, one in particular that I recently heard of and that I went and watched the videos associated to was Meet Kevin. And Meet Kevin has a YouTube channel and is most notably known for his YouTube channel. And he has basically sold off 99% of his portfolio or his holdings in the sense of his conviction or due to his conviction about where the market's going. Now, he explains in these videos that he sold off the majority of his stock portfolio with the anticipation of buying better opportunities in the future, in the future to come. Now, he was faced with so much backlash for this decision, and no matter whether those thoughts or emotions were justified or not, not knowing the comments, I have no idea. We have to keep in mind that this is his portfolio. His tolerance for risk, or his threshold of risk tolerance, and ultimately his belief of where the market is heading. Now, we can easily jump to criticize others' decisions without considering these aspects or considering them as individuals. So no matter who you are, and how big your portfolio is. It's important to know your parameters for your money. Without parameters or boundaries, you will be enticed to buy when there is a frenzy and sell when there's fear. So these boundaries ensure that you don't do that. You don't act from an emotional state. Now, on the contrary, in a logical state, you make logical decisions for your money before there is either a frenzy or a fear to influence you. So you're making these decisions so that when that time comes, you know how to behave in that market. Now, whether you believe that the market has a greater risk of downward pressure or greater gain of upward movement in the future, it's important that you build your plan or portfolio based upon what you are willing to have on the line. Now, too often, I have allowed the fear dictate making moves in the market. So I'm speaking just as much, if not more, to myself in this manner than even you, and providing advice in that manner to you. Now, I believe that people have been operating with a euphoric mindset for years now. Other than the dip in 2020, we have had and been operating with strong growth since the last Great Recession, since the Great Recession of 2008, 2009. Now, this meaning that we've experienced 10 or more years of growth, which has caused many to think that it would always be this way, that it will continue being this way. So this is when it gets dangerous though, when people see little possibility of a downward swing due to how things have performed recently. It's almost like they apply a recency bias of what things cost and the sentiment of investors that will surely continue to trend in that direction. Now, the market is cyclical, period. No ifs, ands, or buts. It is cyclical. Now, whether you are bullish or bearish right now, know why. Know why you are or have that position. Now, make sure that you act with conviction, not just because your Uber driver told you to buy or sell a certain asset class, but because you have applied the time, energy, and conviction to what you believe the market is doing or what it will do in the future. So over the last year or so, we've experienced unbelievable growth in prices. This goes without saying, of course, because we've all experienced it, but this euphoric growth in stocks, home values, vehicles, to just name some, is due to people's spending behaviors based upon an expected continual growth of values in the future. Now, although there are arguments for prices staying high due to inflation and labor prices now, or the cost of labor, or supply chain, or whatever the case may be, I've personally taken the approach that there is more of a downward risk than an upward gain in this market. Now, being that I am more cautious and frugal, I've applied this perspective to much of my investments in an effort to hedge against this. So in the past year or so, I have slowly unloaded assets that I believe were reaching their peak valuations. Now, this first started with me pivoting my stocks and index funds to lower risk investments, then selling off my investment real estate and primary residence, to which I probably, in retrospect, should have kept for another 8 to 12 months at least, being that there was significant gains after the point of my sale. But of course, there's no way of knowing that and knowing how to time that exactly right. But I've since also carefully assessed other aspects of my assets, like vehicles and defense aspects like insurance policies. All of this is in an effort to be defense minded, as I believe that your finances are a long game. And so I agree with Kevin, in the sense that although you cannot specifically time the market, you can know the times in which we are generally, where the market cycle generally is, added to your position in regards to your portfolio, along with your risk tolerance, should then all be factored into your actual investment decisions, rather than what is trending or what your Uber driver, impresses upon you as being a good investment. So remember that your personal finances should be treated like a long game. In certain seasons or specific assets, you may be more bullish, while others, other asset classes, you may be more bearish in. So I would encourage you and I would challenge you to look at whether you have reviewed your position. Is your defense strong? Have you retired debt, built reserves, and worked to protect the aspects of your finances? Now, I recommend that you start with looking at your largest assets and how susceptible you believe they are to downward pressure. Whether in the coming months or coming years, it doesn't matter. Just overall, the downward pressure that they may experience. Then see how long your reserves could support your current lifestyle. This is just starting with knowing what you're spending on a monthly basis and then dividing that into what your assets or your liquid assets are to get that number. Now, once you've looked at these factors, consider your risk tolerance and how exposed you want to be. This, should be a normal practice you and I go through in order to make sure that we are balanced, that we are not placing all of our eggs in just a few baskets. If this information is helpful to you, explore the Margin membership, where me and my team will help you take the information you're learning and apply it to your life and your finances. I've built an interactive course that allows me and my team to come alongside people like you to help you revamp your finances and build margin into your life. Click the link in the description below for more information.